Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So I know we didn't have our EIA and ECON show, so we're going to do a little bit of both and try to merge as much as we can and provide as much information. And one of the key pieces that when you look at the title in terms of completions going up, but the economy slowing, the reason why I wanted to show that is because right now we do still see the completion activity, the underlying activity continuing to stay relatively strong even as things continue to struggle on an economic perspective. Now, eventually you'll start to get some of that coming through to the physical market, to the underlying activity, but we have such a shortfall of crude in the regard to what we have in the US in terms of the natural gas side. So there's a lot of reasons to be active. And it's not that we're short crude, so we're going to go to 300. It's just that we have a lot of demand right now in terms of it's going to Europe, it's being consumed in the US. So not to say that we're going to see all of this huge build in or draw when you look at oil storage, but as we've been saying for the whole year is that storage in the US was going to be flat and that the storage levels weren't going to go up or down, but that it requires something. We had SPR releases, we have some additional activity coming from the US, but Europe has been taking a large part of that, and we want to look at what is driving it, where is this going to continue to go, and as the economy slows, at what point do we really see that crossover and start to hit more on the supply side. So with that being said, we had an increase of 3 spreads. We went from 284 to 287. We had some increase in some of the smaller basins, which is along the lines of what we should be seeing as we go through September and October, which is why we've been saying getting to that 295, 300 by the end of September. It's just, again, that grind higher as we start to get to that level playing field into the end of September, into October, and then start to see that drop off in November. So there's not too much to say in terms of everything that we've seen so far is fairly in line with our expectations. We don't see anything in the numbers or in the separate basins that's surprising. If anything, as we start to get towards the winter months, we'll start to see some additional activity there. As we get into November, we'll see some of the smaller basins drop off again. But along those along those lines, very much just a very normal kind of seasonal move as we continue on. Now, when we look at the rig side, there was an increase in 8 rigs and then a decrease of 4. When you look at what was driving it, again, the horizontal rigs continue to drive higher, continue to be the driving force, which is good. And when you look at DUC count and when you look at the completion side, because it's maintaining that steadiness. Now, the benefit for those in the industry and the ones that are looking at it, even as we see all the volatility, even though we see all this uncertainty, there's still a lot of this very basic demand when you just boil it down to natural gas, NGLs, or liquids, and crude. Just when you look at crude going into the European markets, natural gas as LNG going into the international markets, we're coming into the shoulder season, but giving way into the winter months. And then on the NGL front, even as petchem slows, we're still seeing that usage as it goes abroad. So even as we have petrochemicals coming off, cutting runs in the US, going fully offline within Europe, depending on where they are, you're still seeing that going into the international market, which is providing some of that floor and a bit of that base, which is what we've been discussing so far. Now, when we look at pricing, if you remember, not last week, not this week, obviously, but last week, we had said that the Brent Dubai spread was going to be fairly fixed. It was going to be kind of that sideways move, just because you're getting a lot of these unknowns. Like the market activity has been fairly quiet today. Differentials are coming under more pressure as you start to look at no bids, very few offers from West Africa when you look at the spot market in general. The availability of prompt Nigerian barrels for loading this month is adding pressures on differentials from a weak October. And for those that have been listening to us, we've been talking about how we were going to see it's kind of destabilizing because you saw prices come down at the beginning in the end of August into September, and you started to see some barrels clear. And that's what we were saying. Look, you're finding a bit of a floor here. But then one of the concerns that we really had was as we got out of that period and started getting into some of these other areas, we were going to see some additional weakness coming through. And that's exactly what we had with differentials coming down. And again, that's where another piece was, again, the long delay in selling those September barrels. But that was because they had to go to lower prices. And as we start to get towards the end of October, because September bled over, because we had some of that overhang, that's why we've been saying that you're going to get even additional differential pressure going in from September into October. We've had floating storage increase a bit in the Middle East and in Africa. And remember, the Middle East was the one that we've been the most cautious on, that gives us the most caution, because as that starts to build, they're going to get a bit more aggressive, and then that'll again defer more of those Middle Eastern, the West African crudes into a different month. Now, when we look at storage, not too much of a change in Singapore. As we've been saying, it's going to, from this point, you're going to kind of stay at these levels. We still think, again, gasoline's the problem. We've actually seen gasoline prices go negative. Depending on the type of crude you're running, you're not going to be, there's no margin. So we've seen essentially refiners in Singapore and Asia go full circle. There's been an increase in rumors of South Korea cutting runs, which isn't surprising. So again, that's just going to put more of that crude back on the water. And that is what we continue to see when you look at floating storage, when you look at differentials. So as that continues to bleed out, we're going to see more of that pressure coming through. So now when you look at, and when we look at Europe, you can see that gasoline had a small draw, gas oil small build, but again, nothing that's going to change the direction in which we're moving in a lot of these underlying flows. Now, when we look at EIA, here you can see that there was a small build of 2.44 million barrels coming into the U.S., but then when you follow, obviously, SPR, there was a draw of 5.97 as barrels continue to be released from the SPR. When you look at the builds in general, imports came down, exports came down just a bit when we look at some of the different math. So imports were down a decent amount when you look at the fact that they fell 989,000 barrels. What I meant to say was that it was really only driven by Pad 3. So Pad 3 was the one that saw the drop. Pad 2 still at an elevated level. So when you look at Pad 3, you will get some of that swing back and forth. And then when you look at U.S. exports coming in at 3.5 million, remember we had that huge spike, but it's really that 3.5, 3.7, but as we said, closer to that 3.7, 3.8 million barrels a day heading into the market, especially as we look at some of the issues in the European world. Distillate had a nice build of 4.22 million, but Pad 1 had a draw. And again, Pad 1 is the biggest driver as gasoline continues to be fairly stable. Small draw of 1.77 million, but still nothing too crazy as you look at implied demand. So the gasoline number was a bit low. We have it closer to about 8.7 million. But still, again, on the downtrend, still lower. It's the distillate one that gives us the biggest pause, because that is where we do see a drop, and we see it actually getting a bit worse just given the activity front, and we'll go through some of that just as we go through here. So when you look on the trucking side, you've seen a bit of a flattening, but we want to look at how that is flattening in general and what is some of the leading indicators. And the leading indicators we're using is what's coming to the coast, which is actually below summer of 2019. And it just means that we should actually be going up, not down, because this is when you're importing for your Christmas, for your holiday push, and we're not seeing that materialize, which is, I think, a bigger concern on a broader economic level, not just in the U.S., but on a global macro side. So we do see some stabilizing of the trucking side, but there is going to be that downward pressure as that continues to flow through. When we look at the gasoline demand side, here you can see that China is starting to fall back down. We see that coming back down through here, just as we've had some of the some new lockdowns, some lockdowns easing. It just depends on where you're looking at this point. Now, when you look at Google mobility, there's been a nice recovery in Europe, while things in the U.S., or I should say in the Americas, still remain fairly flat. We don't see too much change here. The one thing that we do see is Asia Pacific again having that role, and the one thing I find the most interesting looking at this data is you see the Google Mobility Index, which remains elevated for Asia Pacific, but then you look at all of the I don't want to say uprisings. It's like the social unrest, which continues to roll through, but yet you still have the mobility. So at some point, those two are going to merge, and clearly we've been wrong because I've been saying, look, it's going to merge here, and it's not. It's still elevated, which is a net positive when you think about the amount of gasoline that is just sloshing around in Asia. This will help absorb some of that, maybe giving a little bit of a bump to some of those crack spreads. And as you can see from the TomTom side, that is being reflected in the European and the Asian front. And based on, the Americas staying fairly stable, we should see some of that stabilization and moving higher on the demand front for gasoline. Now, when we look at the TEUs coming in, this is what we were talking about. Now, this is something off of Twitter from Craig Fuller from FreightWaves. So container freight bound for the U.S. leaving port of origin have now dropped below summer 2019 levels. It will take a few months before this shows up on the U.S. import number side, but the outlook is very negative, and this is supposed to be peak season. And that's the biggest concern. That's what we've been talking about in terms of sales. And realistically, and Twain's Mustache made the comment on Twitter, was that this is the end of the bullwhip. Like the bullwhip has passed, and this is that coming through where you're getting that drop off. And this is going to lead to more pain in the emerging market front, more pain on the global macro basis, which is what we've been talking about. But we still have a shortage of supply. And that's and when I say that, I'm talking about on the raw material side, on the core materials. So even though demand has come down, supply has been fairly low. So at some point you'll find equilibrium and even go past it, but it just highlights that demand's going to have to fall much further in order to get some of that price adjustment. Now, when you look at the Empire State Manufacturing Survey for the delivery time, this is again showing you that things have snapped aggressively the other way. Forward-looking delivery times, which goes out 6 months, component within September, Empire Manufacturing has collapsed and is at its lowest, most negative since July 2008. So again, you're getting back towards that, just the low end, because now everyone has their inventory. Everyone has, if you want it, you've gotten it, and you probably have too much of it. And that's where we've come to the end of that bullwhip. But a lot of the stuff that you purchased was at an elevated price. So you still have expensive inventory, but you have a weakening consumer. And that's when you get this weird, okay, well, how high can I keep prices and still get people buying, so I don't take a huge bath on the inventory I've purchased? And that's what we talked about in 2020 and in 2021, that companies were going to have to try to manage that inventory level so that they're not stuck with this very expensive piece sitting on the sidelines. Now that filters down to Asia crude side. So Asia's crude imports are set for another soft outcome in September, staying below 25 million barrels a day for a fourth month. While, and again, the retail fuel prices across Asia are elevated, and it's hurting demand and again, keeping that inflation push, but you're still seeing some of that gasoline purchase. But now the interesting thing is going to be all the new Chinese quotas. So they increase some of the quotas in terms of the availability on the export of product. And the question is going to be how much of that can go into the market. And we saw a little bit more buying from them, as we discussed, last week and the beginning of this week. But we don't see a huge pickup. Again, it's going to be a very stable, just because there's so much product in storage. There's about 925, 950 million barrels of storage. Then when you factor in what's in on the refined product side, it's about you get to about 1.9, 1.95 billion barrels sitting in storage, and they have to clear some of that out in order to take in that crude. So to clear out the refining side, make some additional storage available, bring in some of the additional crude, get some of those utilization rates, but they've been dropping. So it's not like there's a lot of activity happening, which is going to keep things fairly balanced. Now, when you look over to the inflation front, core CPI came in at 6.3% on a year-over-year on the 12-month growth rate side. So again, you're still seeing this inflation. The biggest issue that we're seeing is obviously the Cleveland median, and the 16% trimmed is still above core. You're still seeing, again, that drive up, and it's OER, so the owner's equivalent rent, still moving at levels that we haven't seen since 1982. You're seeing a lot of these pain points. And yes, gasoline prices have come down. That's obviously a good thing for sentiment. That's a good thing for the consumer. But you're still seeing a lot of this pressure to the upside, a lot of these movements up, and that's again some of these problems that we're seeing that are I think are a big issue in general. As we look at a lot of this activity, that pricing is flatlining, but it's, again, that stagflation is more of what we're seeing. So then when you look at the Atlanta Fed core, this is, I think, a bigger issue. So core sticky CPI increased at 6%, increased at a rate of 6%, the fastest rate since 1982. And you're getting an idea that, again, this is what's going to remain. You're going to get, as we said, some of that flexible inflation, which gasoline falls under, is going to drop. But this is what is going to bite. This is the one that's going to sit behind. And when you look at food prices are back up. You have more fertilizer capacity coming offline. You're seeing a lot of these pressure points that are really driving this higher and creating a lot of these additional issues. All the while, real average hourly earnings fell by 3.4% year on year in August. An improvement from 3.6, a drop of 3.6. But again, that's not huge. You're still negative. You're still in a point of pain when you look at the inflationary side, especially when you look at what people are spending money on, which is all types of just the what you need to live. Your home, your food, all of these pieces are continuing to be that hit. Now on the PPI side, yesterday's CPI report, today PPI's report shows that inflation pressures remain. They've come down, but where? So when you look at final demand was negative 0.1, but then when you look at core, it was 0.4. So again, that's the biggest issue when you look at core side. What is going to hit people the hardest? And that's the thing that people rely on. That's the one that it is slow to go up, but once it goes up, it's very hard to bring it back down. And this is that leading indicator for CPI because, again, companies are going to try to pass on as much of this as possible to try to recover and protect some of their margin, which you can see here. So the divergence, August PPI was negative 0.1 against the estimate, which was right in line, but core PPI came in at 0.4 versus the estimate of 0.3. So you're actually starting to see a little bit of a reacceleration on the core side, which again is going to hit the consumer the hardest. And that's when you start looking at the sticky CPI, which is why we come back to the same chart, because if PPI is going up again and reaccelerating, there's nothing that's going to drop this core inflation number, which is why we see these problems, we see these issues continuing to remain pervasive throughout the next few months. So, and then CEOs are not, they know this. So the CEO economic outlook and CapEx plan continues to sour. And as they cut CapEx, it means that they're going to cut growth. They're going to try to be protective. And that's where we continue to see a lot of these downward trends. So U.S. industrial production here, industrial production came at negative 0.2 versus the estimate of flat. So a monthly drop worse since December of 2021. But again, you're just flatlining. You're not seeing a huge drop. Just again, a lot of the stabilizing. And that's when you start looking at some of the Empire data, the Philly data. It's falling, but not a crazy amount, which is why You still need these core materials. You still need that, and we need to see this really roll over before we start to see the bigger hit on the energy side, on the the material side, and that's some of that disconnect that we were discussing before. August retail sales. So retail sales came in at positive 0.3 versus the estimate of negative 0.1, but ex autos it was negative 3. So negative 0.3%. Then when you look at ex autos, gasoline came in a positive 0.3 versus the prior 0.3, which was revised down from 0.7. But the control group, the one that we've been looking at the most, came in flat, and it was expected to be up 0.4. And that's, again, that core piece that we've been talking about. And now when you factor that in for inflation, the control group was actually negative, which is why when you look at the nominal side, the people are still paying more, but they're getting less stuff. And that's that, again, the value versus volume. Now, one of the key pieces that's going to continue to hit hard, average 30-year mortgage rate has increased by 3.2% over the past year, fastest rate since late 1981. As we continue to see, again, that movement, we're now well over 6%. But again, the acceleration is what caught people a lot of, very flat-footed when you look at some of those increases. So now when you look at the University of Michigan Consumer Sentiment Index, it came up slightly of 1.3 points to 59.5 in September, but it should. As we said before, you're going to get that bounce because gasoline's a big number. People feel that, they see that, so you'll get that bounce and again movement sideways. Current conditions came in at 58.9, which was near the record low. Expectations at 59.9. So again, people are still not feeling great about their current condition, the expectations going forward, and that's where you get some of this flatlining for the most part. So consumer morale remains depressed amid elevated uncertainty. Again, but the gas price dropping helps, but we're not seeing the same thing on diesel. Again, diesel prices have come down, but not all that meaningful. And the question is, when is that going to really drop down, which would help, again, alleviate some of that pain. But based on the PPI number we saw, we're not seeing much of that yet. And that's going to be the key piece to watch on how we start to see more, a little bit of deflation starting to come into the market. And again, not deflation coming from 2019, but just from these crazy level prices that we have right now. Now, when you start looking at the personal finance front, personal finance components of the index was well below as, buying for durables remained at similar relatively low levels. Again, so you're just seeing that confidence on the consumer confidence sentiment index just remaining at that sticky front. So when we just look at some of the one of the things that I just wanted to iron out was that when you look at retail sales, it was at negative 0.3, negative 0.4% when you factored in and adjusted for inflation. So the consumer is struggling. This consumer pain is there, but it's not going to show up in U.S. activity yet. Especially on what's happening in the oil patch, because you do have that disconnect. You do have that avenue. So we do see that pretty steady completion activity as we get into next year. That's when you could get a much bigger hit. We've already seen that Saudi and OPEC is willing to cut more aggressively to try to keep prices here. But keeping prices at these levels is also bad for inflation. So, at some point we'll explain how next year we'll have the Fed, we'll have DC going around with victory laps because we're going to see inflation's declining. No, that's the base effect. Show me when we're accelerating below the base effect, and then I will say that there is a change. But so far, there hasn't been, which is why we think Jeremy Powell is going to continue to be aggressive on the rates front, and the rates are going to stay elevated for a lot longer. And I don't think that's something the market has truly appreciated yet, providing some more additional downside. So that's what we have for you today. I hope you all have a great weekend, and we won't have the EIA and ECON show next week. We'll do another consolidated show on Friday, and then we'll get back to normal after that. So thanks for sticking with us, and we hope you have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.